In today's video, we'll take a look at the latest Fed fund rate decision in the interest rate, the inflation rate for consumer, producer, personal consumption index, some very important economic data. My name is Anna Eckstein, Naples Ultimate Luxury Group, Realty One Group MVP. Let's start. All right, let's start with the last Fed interest rate decision that happened on January 29. And the expectation was the Fed wouldn't change their funds rate, and it's remained steady between 4.25% and 4.5%. So there's no rate cuts at the last meeting. If you like to take a look to see what happened in a previous meeting on December 18, we had the 25 basis points cut, totaling the cut so far for 2024. And up today is 100 basis points. And the federal fund rate was from 5.5%, went down between, like roughly, it's about 4.5%. So what major change, not last meeting, but the meeting prior, is actually change projection, because projection was, and you can see in November meeting, the projections was the interest rate will be actually, there's more rate cuts will be coming in 2025. They didn't change that projection in the meeting of the December, and they kind of stick to that in January meeting as well, because there's no like significant updates was for the January meeting. They say, yes, you know, the inflation, and I will share with you charts just in a moment, the inflation still being sticky. As they continue, there was a lot of questions about the tariffs that will be coming, the new administration, and Mr. Powell says, well, we'll be reacting and processing information as information comes, as we would do to any administration, and adapt to the new policies as they continue to navigate the today's economy. So that's pretty much what they say. So we'll see as the data flow. And if things change, we'll be reacting appropriately to the changes that needs to be made. So if you like to take a pause and take a look what November 7 was, what actually in December projection for the higher for longer, basically, less rate cuts. The anticipation for the actually 2025, there's still 50 basis points, of course, depending on the data. So let's move forward. If you like to pause, also to take a look at the economic projection, what they expecting GDP to be positive, right around, 2%, like 2.1, around 2% for 2025. Moving forward, 2026, we're still in that 2% target range as a projection. Longer run, it's also 1.8%. Unemployment stays relatively low to historical averages, and we would be run somewhere in the low 4% for the unemployment rate. The PCE is still considering to be sticky. PCE is a personal consumption index, which is preferred gauge for the inflation for the Fed. And as you can see, the projection still is sticky. The target rate, as we all know on this channel, is at 2%. For the Fed, we'll see how that can happen. And this is the chart that I showed to you previously. So the 10-year, the reason why I'm sharing the 10-year yield, the Treasury yield on this channel, because this is something that when Fed lowering their internal fund rate, they're actually lowering the short-term overnight rates. It's a short-term related to like 2-year yields, things like that, on the short-term debt, not on the long-term debt. The long-term debt, it's actually directly correlates with 10-year yield. That's why it's very important if you shop in on the market for the mortgage, and you're looking for a home, it's important to take a look and track where the 10-year yield sitting at, because that's directly correlation actually to the 30-year mortgage on average. And you can see this is actually were created on Monday. So right now yield actually roughly about 4.41 or 4.42% as I'm recording this video. And I'm recording this video on Wednesday. So the reason why I always like to look at the historical data kind of to understand where we've been, historically. And for the 2024, as you can see, the highest would be actually 4.7 on April 25th, 2024. And the lowest we actually been on September 16, 3.62 is right before the Fed start lowering their rates. And after that, just 10 years shoot up as we speak. So the highest was actually around, we actually reached around 4.7-ish, which changed not too long ago in 2025. So anyway, this is historical, actually, a chart that I'd like to share with you. You wonder where's the highest yield possibly been. It was actually July 1981. It's been 15.82%. The lowest we had April 2020 at under 1%, 0.65. So the 10-year Treasury yield, why is important to understand if the yield is let's say 4.42 right now. And the mortgage rates, we're still looking right now, it's actually just shy of 7% for the 30-year MBA. And so the difference is a spread. The spread is a risk, what investor demanding basically. And the spread is depending on so many different factors. So right now, spread roughly is about 2.4% is between 10-year yield and actual mortgage rate, roughly, because it's fluctuating, right? So if you look at historically, we actually, in 2008 crisis, the yield was actually, the spread was about 1.5%. So think about the reason why I'm sharing with you, because think about this way. Even if the spread, if the financial condition will be a little bit loosened, there maybe will be more risk for the recession. Let's say perhaps the Fed will be purchasing, let's say, more MBS securities, things like that. This is actually the list of the fluctuation of that spread, that even, let's say, perhaps 10-year yield will be, let's say, at this range, right? But the spread will be lower. The mortgage rate will be lower as well. That's the reason why I'm sharing with you this information. So the latest on the 30-year mortgage rate, very simple, 30-year fix on confirming loans balances 766,550. We just had the latest was, I think was today or yesterday, was recorded as of the week of the 31st. It's 6.97%. So we really didn't go nowhere. We just plateau around the 7% as we speak. This is an interesting chart. I was like, first, I just couldn't understand. I couldn't believe it, let's say this way. I don't know if this is like error in the system, but I do getting this data from the trading economics. And when I saw the mortgage rate was jump in January 10 by 33.3%, first I thought like, well, maybe this is like an error or something. I like triple check like 3 times. And it's still saying that mortgage rate jumped. So I don't really have like a whole lot of explanation, but I just wanted to share with you because something that I'm keep tracking this on a weekly basis to understand where we at from not only economic standpoint, but also from the housing market. As you guys know, I'm a real estate agent. So for me to understand where we at on mortgage rates and housing data, it's super important. And I do share a lot of the type of data on this channel. So please take a look at some other videos. I do economic reports along with the housing updates. So encourage to look at the videos because I posting them regularly as I creating those updates on a monthly basis. So anyway, 30-year mortgage rate, where we've been the highest, 7.22%, May 1st, 2024. The lowest again we had right before the Fed decided to lowering the Fed fund rate. We were 6.08%, and right now we're right around 7%. So historically, the highest interest rate that been recorded in United States history was in October 8, 1981, was 18.63%. The lowest one we had, lucky one, if you guys have this interest rate, but was actually 2.6%. December 23rd, like a Christmas gift, right? That would be a really nice one, 30-year. I would take it anytime. 2020, 2.66%. That's amazing. Like, I honestly, I don't foresee anytime soon these rates will be close to even 4%. Like, no way. I mean, it's just no way. I just don't see it. We'll be lucky if they will be close to 6 or go under 6, and we can see them in a 5. I think that will make a huge significant improvement for the real estate sales, the buyer support. And take a look at some of my videos, because we are losing buyer support a lot. And that's really concerning to me, because in a lot of the areas, our medium sales price is actually plateau, but some of the areas we lost buyer support compared to 2022, 2021 by almost 50%. So anyway, let's move on. The inflation. The reason why we would like to keep an eye on inflation and pay attention to these numbers, because the Federal Reserve paying attention as well. And based on inflation and so many as different factors, like the two priorities for the Federal Reserve to keep the stable employment and the inflation in the U.S. economy. So the inflation, and we always look in inflation rate and also core inflation. Core inflation is excluded volatile items such as energy and food. So first we'll take a look at inflation, and as you can see, the lowest we had so far for the past 12 months is 2.4%, was in September. Since that, we on the uptick. And remember, the Fed started lowering the rates in September. So that's why the more they reduce how many times they will lower the rate as we speak in 2025. Just for this data right here, you can see that since September, we actually start on an uptick, and the last reading that we had in December, again, we're going in the 30 days, the data. So the next video, I'll be recording the data for the January. Once it's come in, will be mid-February, general, the inflation report. Then I'm waiting the whole month so I can get the inflation report, the personal consumption index, the producer inflation report, things like that. And then I consolidate everything and report for you at the end of on the beginning of the months for the previous months. So you can see the highest inflation that we actually had was for the past 5 years in 2022, and that was 9.1%. And the lowest we had is 0.1 in 2020. That's, of course, our COVID inflation rate before the inflation spike. And right now we're 2.9%. So the target rate, again, is 2%. Core inflation, also you can see it's basically as sticky as can be. From the July, we basically just trading water, nothing burger here. So 3.2, then 3.3, 3.3, 3.2. That's the one that excluded volatile items. And you can see that the highest we had for the past 5 years was 6.6% in September of 2022. The lowest 1.2% in June 2020. So if you like to pause and take a look, this is optimized categories of the inflation that travel for the past since June to the December of the 2024, and you can pause and take a look where it's been going, inflation, and things like that. And a lot of people say, well, the inflation is the 2.4% or whatever right now. The target rate is 2, so hopefully we can see some prices down. It's not how inflation works. The inflation is still here. The price is still going up. They're just not going up as much as they were going up back in 2022, when then our inflation was at 9.1%. So they're still going up. We're not going in disinflation. We're still in the inflation, just not as much as we used to be. So producer price index, that's the inflation on producer side. The reason why I share with you, because anytime when you see inflationary scenario on the producer side, think about who will be transferred to the consumer. That's the reason why important is to take a look at those numbers as well. And you can see that on the producer side, we actually at 3.3%. The target rate, again, is 2%. So back the highest, we were at 11.7% March 2022, and the lowest we actually were in disinflation. So when you see the inflation is minus 1%, that means that we're going in disinflation. So when you see in a plus category, it's still inflation. The price is still going up, just not as much. So core producer, we at 3.5%. The highest we had 9.7% in March 2022. The lowest 0.3% in June 2020. I think I like to share with you the highest so you kind of know where we at like right now, you know, how bad or how good it is and where we've been. So I think it's important to understand the numbers, the federal government expectation for the future, things like that. So PCE, that's preferred gauge inflation for the federal government. And this is the personal consumption index. And you can see it's been going up since September. We're now at 2.6%, target rate 2%, 7.2% we were June 2020, and the lowest 0.4% was in April 2020. Yeah, that's right. I think this is actually a mistype because June 2022, because there's no way the April and June, they can rose that much. And by looking right now, it is mistype. So I will correct that for the next video. But June 2022, that was the highest. So the core PCE right now with 2.8, the lowest was just under 1%, the highest 5.6% in February 2022. So this is some really historical data. Go back, gosh, on some slides like inflation, I had data back in 1930s, but I just want to pick point like where we were historically, right? So in the 80s, Paul Walker era, so we were, remember guys, I don't know if you remember, there was like a double top that they thought that they deflate inflation, yay, like we're on recovery, and then, oh shoot, there's reinflation. So a lot of the economists right now, you know, for the past 2 years at least, there was always comparing to something like this, and that's, can we expect some sort of reinflation that can come to the economy from who knows different reasons, for example, tariffs. You know, who knows? Time will tell. We will see. I don't have a crystal ball, and I don't like to guess on this channel, but I do have my 2 cents opinion on how certain things works in economy, but let's just leave on that. And this, you can see that in the 80s, the inflation was 14.8%. The core was running 3.6%, and the PCE was running around 11.6%, the highest, and the same thing, core PCE was running around 10.2%. So the lowest, you can also take a look, we were in disinflation in 2009. That's where the housing crisis happened, GFC crisis, global financial, and you can see that we were definitely in disinflation over there. And this is obviously where we are today. So retail sale. So reason why we should pay attention on retail sale, because this is one of the indicators of consumer health, right? and financial health. And so you can still, we kind of still there. In my opinion, I mean, obviously the consumer get weaker and weaker. The credit card debts, maybe this is something that I should share with you next time. The credit card debts, I mean, globally is on a rise, especially in the United States. It's, you know, it doesn't look good, let's say this way. But I just wanted to share with you was 3.9 year over year in December. Personal income rose by 0.4%, but personal spending rose 0.7%. So the reason why I'm sharing with you, because the personal income rose 0.4, right? But the spending, the consumer is just many of the consumers, they just so depending on those credit cards at this point, and the interest rate is so high, and it's just the whole debt is so high with the debt, with the interest rate, with just so many different issues. But this is one of the charts that I like to watch, because it gives you an idea that yes, the income is keep going up a little bit here and there, but the expenditure is doubling technically the income for majority of the charts. So non-farm payroll, why is that important? Because this is our economic strength, and we need to understand where we at with unemployment rate. We need to understand with the job stability, because it's one of the mandates for the Fed is the low inflation and the job stability. So, and just so you know, if you guys wonder, because the way how our government works, you know, we accumulate the data, they report the data, and then going in back and revise the data. So if you look in my charts, the past charts are revised. So they may come back and revise like December data, but that will not going to show up right now. It will show up later. I remember this August data. They come in and they say there's like 146 roughly 1,000 jobs. I don't remember exactly what it was, but then they come back in September and they revise this to like 10,000 higher. And then they come back in October and they revise this to 78,000. Just so you know, like, it's funny. If you would go back and keep tracking these videos, you will see that these numbers probably would look different. And that's why I started recording these numbers, because as we're moving forward, you can go back like the next video that I will record, and let's see if this number change, right? And then they do monthly revision, and then they do annual revision. And I believe annual revision for the previous year, I think it's around springtime, don't quote me, I think it's around March or so, that they will do for the whole year revision. And like they did for the previous year revision, last year in 2024 for 2023, they overestimated from these numbers, what you see right now, like not from this exactly numbers, for the numbers for the 2023, by like 881,000 jobs or something like this. How you can overestimate that? It's a good question. But it is what it is. So if you wonder from the historical point for the past 3 years, the highest job, the production was in February 2022. We produced 862,000 jobs. And the lowest was in October 2024. It's 43,000 jobs. So unemployment rate historically, and now you can see historically, unemployment rate, we remained relatively low, 4.1% for the December. And you can see at the COVID, obviously, that was craziness, 14.9%. The another highest percentage was, I think, like you would agree, would be pretty equal. In 2009 was 10%. That's your GFC crisis. And December 1982 was 10.8%. So this is just a small graph of breakdown between the government jobs. So if you wonder where the creation of the jobs, this is obviously the private payroll, non-farm, excluding the farmers and some other categories. So it's from the private companies. This is manufacturing payroll. You can see our manufacturing, in my opinion, was in recession for quite some time. But this is the government payroll. And average hourly earnings, so we're still 3.9% year over year. And this is some historical data. You can see the average our earnings year over year. So historically, we were at the 8% in 2020. The lowest we actually was in 2021. And right now we're at 3.9%. So this is just something that I decided to keep this chart as we continue rolling. This is charts now updating every month. They're updating quarterly. So this is our last update was for the fourth quarter. We are annualized GDP grow at 2.3%. That's where we at end up 2024 fourth quarter. Just so you guys know, the GDP sale was end up to be for that quarter 3.2%. The consumer spending 4.2%. So the consumer is still there. How long will be hanging there? That's a good question. So PCE prices, reason why I'm sharing you because that's the prefer for the Fed prefer gauge for the inflation, and we are at 2.3% on a quarterly expectation, and that we close fourth quarter, and the core PCE we close 2.5%. And prefer number is 2%. So that was actually my last slide for today. Thanks so much for watching this video. I hope you find this video valuable for you and for your family. If you do so, please don't forget to subscribe to the channel below. My name is Anna Eckstein, Naples Ultimate Luxury Group, Realty One Group MVP. Thanks so much for watching. Have a great day.
You're giving me wind and rain.